Good afternoon, everyone. In today's video, I'd like to talk about three different things. The first is going to be a trade idea in Tesla. This is going to be a butterfly in which we're really trying to play the squeeze move, and then we're going to build it out to try and target this 550, but allow it to overshoot. So that's the first thing. The second thing we'll talk about is a trade in the Russell futures, which was a loser, but we'll also talk about how we adapted to the volatility that we saw there. And then we're going to finally conclude with a trade in crude oil, which was also a short opportunity, but this time a winner. So that should help give a good idea of what a loser and a winner looks like with the futures volatility box. But first, let's start with Tesla. So now Tesla here, the reason why it came onto our scans was a result of the squeeze signal populating on our charts today. You'll notice this is the second time that's happened. The first time we had it, it still hasn't really triggered long, so the setup is still valid. We really just chopped around sideways, pulled back to the market post line. Now looks like we're getting ready to go again. The one thing that I thought was interesting here that I'll call out is if you take the last time you had the signal, draw this out really like a line in the sand. So that's really right around that 450 mark. You'll notice today so far, we're really right around that same price level as well. So I think that gives you this notion that, hey, you're still getting an entry close to where you originally first saw that signal pan out. Now you come in and you take a look at some other factors that I think would influence the setup. One, you see the squeeze that looks like it's about to fire long. Second, if you come in and take a look at the volume, you'll notice that today's volume bar was a little bit above average, above that 50-period simple average. And then finally, if you draw your swing high to your swing low to try and find an area in which you're looking to try and target, you'll notice that first zone is right around that 550 mark, 549.44. Now, if we bring this down a little bit, you'll also notice that that brings us really close to that 600 mark in Tesla. And for anyone who's traded Tesla, especially the squeezes in Tesla, you know that it's not one of those grind up higher type of moves usually, but instead just ends up going right away and oftentimes overshoots this 1272. Thus, this notion that when we build this butterfly, we want to build it in such a way that it allows us to have some flexibility in managing it if, say, we weren't completely right around the zone in which we were trying to pin, which we're going to build it around the 550 as the body of that butterfly, but we'd like to make sure that the wings really allow us to have as much flexibility as possible. So let's come into the trade tab here. And then I've already built it out in Tesla, but let's go ahead and do it from scratch. So this is the 31 days to expiration series. We'll come in, we'll start by building this around that 550 body right here. So 550, right click, build or buy butterfly. And then once we get that, I'd like to adjust the strikes here just so we can try and have a little bit more flexibility. So we're going to adjust this from a 540 down to the 530. The 530 is the next available strike if we look on our options chain. And then currently this is going for $1.55, anywhere between $1.55 to $2.25. Come in, we analyze this trade here. There's two of them, so let me uncheck one. Now you'll notice that if we look at this in terms of a risk to reward, your max loss on this trade is say we're completely wrong about this idea and by December you get nowhere close to that 550 zone, then that's a loss of negative 155. Now say that we are right about this idea, but we overshoot the 550 mark, then you've capped out your gains at 845, right? If I hover over this, you'll see that populate in the bottom left, 845. So if we go ahead and add that in, so that's 845 is really your worst case scenario if you overshoot it. So you really have no upside risk. And then now let's say that we were absolutely on the point here with the 550 mark, then you'll notice that that gives us a net P&L of 1840, which gives you a fairly nice trade in my opinion in terms of the amount of risk to try and see if we get this long squeeze panning out in the case of Tesla. Now, one other thing that I'll point out is if we duplicate this right here, so we'll create a duplicate order, and then instead of making this a 530, if we come back in, change this to a 540, you'll notice the cost of that goes way down. That's between 15 to 85 cents. For those of you that are trying to keep costs a bit lower, that's another alternative, but I think this requires you to have a little bit more active management, where as soon as you hit that 550 zone, you start to take the trade off. So I think that's the way I would play it. So I think the unbalanced way gives you a bit more flexibility, but having a balanced butterfly here gives you a cheaper cost. Now, the next thing we said we'd talk about in today's video was the Russell futures. So let's come into a chart of the Russell, come into a 1-minute chart. We'll load in our scalper volatility box, which is the first most aggressive models we were on as the morning started off. And then once that's loaded in, let's come all the way back to the morning here, where you'll notice as the day started off with the Russell here, we first bounced into our volatility box sign entry lines. This sign entry line is usually where we're looking at an entry. This first hour is just pure information to try and really get our bearings, try and figure out which volatility model we can use. So you'll notice up here we have our scalper, then it goes scalper, aggressive, then from the aggressive to the doomsday aggressive, then from that to the conservative, and then finally if we break even the conservative, then that takes us to the doomsday stay conservative. So starting off in the morning here, we really bounced into our sign line, but then we bounced away from it. So far we had the confidence that the scalper was being respected. Then we really had the Russell continue to chop around sideways here until we breached the upper end of our volatility box, and this was towards the edge of an hour. So that's any time after the 50 candle. So in this case, it was 7:52. After that 7:50 candle, this is where it's just free information. We're taking a look to see whether or not the scalper is respected. By respect, that really is defined by, if you take this move right here, do we see the move in the opposite direction prior to going outside of the clouds? So in the case of the Russell futures here, that was right around 2.93 points. And if we take a look to see what the follow through was, that was only 2.2 points before the Russell continued to keep going out. So this right here was your sign that, hey, the scalper's not doing a good job of holding the volatility in the Russell, and instead we need to switch over to our aggressive model. So that's where we adapt to volatility. So if I load in the aggressive volatility box here, now we come in and we take a look to see if we had another breach, where in the subsequent hour here, in the 8 to 9 a.m. Pacific, we breached again one more time. This time we did get an edge signal, and this time you did have an opportunity to enter at the cyan line or better. So this is it. This is the trade in terms of getting filled. All of the rules were met. The bare minimum move that we were looking for in the Russell for this trade was, if you again take the cyan line to the outer edge of the clouds, that's 4.1 points. We didn't get that 4.1, but instead, if I keep going forward here, you'll see the Russell just continue to keep grinding up higher, where we were stopped out as price action went outside of the clouds right here. And then once that happened, that was really our sign to get out of the trade. This is where the stop was hit. Once that happens, we also know that the aggressive is not doing a good job of holding volatility here. And that then brings us to our doomsday aggressive volatility box models. And that's how you adapt to volatility. So that was the one trade in the Russell. Now, if we repeat the same process in crude, so we start with our aggressive model in the case of crude here. And we repeat the same exact thing. So the aggressive volatility box model is where we started off with crude. Now we come in, we take a look. We're trying to see any place in which we breach either side cyan entry lines. The first time that happened was in the 11 to 12 p.m. Pacific hour. We had price action breach above our cyan entry line right here. Right. So now we come in, we take a look to see what happens there. Once we see this breach, we're looking for an edge signal confirmation, which is our overbought oversold indicator on at least a 1 minute time frame chart. We got that right here. We also had an opportunity to enter at the cyan line or better, and that was it. Very similar to the Russell, this is where the trade gets filled. Now, just like before, the stop is outside of the volatility box, and that bare minimum move we're looking for in the case of crude is 15 cents or 150 bucks. Now, if I zoom out here, so now you'll see in the case of crude here, we got some really nice follow through, right? So the first target is again that 15 cents, which was hit. Then once that 15 cents was hit, the stop was taken out from outside of the clouds down to break even. And the second target is at the gray target line on the opposite side, which you'll notice was hit a little bit later on, but that gave you a really nice trade with the T2. So that T2, to give you an idea of what that was like, was 33 cents, in which you were risking 0 on that second contract with the stop being moved to break even to try and make 33 cents if you did hit that, and if you didn't hit that, then the stop was taken out at break even. Now you'll notice with crude, that really helped us to make back the trade. And then finally, after the market closed, this is in that 1 to 2 p.m. Pacific hour, we had another breach, which again was respected, and you come in and take a look to see how crude is open so far. We're now just chopping around sideways in between our volatility box lines. So again, to summarize all the things we talked about in today's video, the 3 different things. The first was the trade idea in Tesla, in which you had 2 different butterfly choices based on if you wanted to optimize for flexibility or cost. The second was our trade in the Russell futures, which was a loser. And then finally, we talked about the trade in crude, which gave us our T1 and T2, so first and second targets, which really helped to make back some of the losses of the Russell and then end the day on a positive note from a volatility box day trading standpoint. All right, hope this video helps. Take care, everyone. Good luck trading, and we'll see you in the next update.